This is the biggest trading week for the greenback with the FOMC rate decision in focus. Markets are split as to whether they're going to cut by 25 or 50 basis points. How is the dollar going to react? Guys, Ken Chigbo back with another E8 market fundamental update. Let's jump straight into this. So this has to be the biggest trading event of the year so far, because we've finally got to a place now where the FOMC are going to be cutting rates after their stance of higher for longer. Remember, they kept interest rates higher for longer in order to bring down inflation. Now, just quickly, as a recap, we've been going over this in recent videos, but remember the dollar had been on this path to the upside at the commencement of 2024. It's supported by those three key pillars. One, economic data was just solid. Two, inflation remained sticky, which means three, the FOMC needs to keep rates higher for longer. All of that was supporting the greenback to the upside. Now, since sort of mid-June towards sort of early July, those three key pillars started to erode. Data was starting to soften. The FOMC's stance was becoming more dovish because inflation, point three, the pillar three, inflation was starting to. Now, as you can see, obviously the dollar completely pared back that move that we'd set out at the start of 2024. This is a big decision. I can't stress that enough because markets are so split. If you look at the CME Group's Fed Watch tool, you can see just how split they are. The probabilities change drastically. 50% probability of a 50 basis point cut, 50% probability of a 25 basis point cut. Bear in mind, just a week ago, that was largely in favor of just seeing a 25 basis point cut in terms of market pricing there. Now, just on that point, last week we had inflation data, which, you know, for me, is still a little bit sticky there on the core, 0.3%. Month for month there, 0.2, year on year on an annualized level, on an annualized basis, are still somewhat sticky. Yes, we've cooled down from 2.9, but 2.5 still away from the FOMC's target. They want it closer, you know, at 2% mark. Okay, and we're just above that. PPIs here also a little bit sticky in the latest readings. However, the previous ones were revised lower, so I guess somewhat mixed. But for me, for them to go and cut by 50 basis points is quite drastic. Because you guys also remember, guys, it's really important before we take a look at some more points. We cut rates in times of economic downturn, okay? Yes, we've seen inflation cooling a little bit here. Yes, we've seen data softening, but we're not in a massive, economic downturn. Yes, there are some red flags, but I don't think the FOMC will want to take such drastic action right now. They want to still keep some ammo in their arsenal instead of just going guns blazing straight away. Okay, they want to maybe cut 25 basis points first and then assess the impact of that 25 basis point cut before they start taking action again. Because if they cut too drastically as well, bear in mind, inflation could creep up. Because remember, we're lowering people's borrowing costs when we're cutting interest rates. You understand that? We're bringing down people's interest that they're paying on their, their credit cards, their short-term debt, their mortgages, so on and so forth. All right. So fast forward, ahead of these US rate decision, we're going to keep an eye on US retail sales. Again, this could further reinforce a bit of a slowdown in the economy. Retail sales expected to cool down to 0.2 from 0.4% on the core. The month-to-month headline expected a contraction of 0.2% from 1%. All right. Now, one of the key things as well, just to bear in mind, is the NFP report. Right. If we look at jobs in the United States, let's go out to that. Go to that release there. Obviously, in the latest jobs report, with last couple of readings, we're seeing less jobs being added to the economy. So yes, that suggests a slowdown there. We get less jobs being added. But one of the important things as well, where the FOMC might want an element of caution and not cutting by too drastically, is wages are still high. They're still sticky. In the latest run, really, wages still generally quite high. Okay, if people still get paid decent money, that's inflationary, right? We're getting paid more money. What we're going to be doing? Spend, stimulating the economy, keeping price of goods and services higher. So I think that's enough reason why FOMC might be a little bit cautious. The unemployment rate still, yes, I know we've been worsening, creeping up a little bit higher, but 4.2% is still relatively healthy. We've still got a low unemployment rate. If we've got a low unemployment rate, what does that mean? We've got more people still in, that's in work, going out to go and spend, stimulate the economy still somewhat, stimulate prices of goods and services. So are we really going to see the FOMC coming out and cutting so drastically by 50 basis points, which suggests there's a 50% probability that they could do that? I'm leaning towards a 25 basis point cut in my opinion. Now, if we look at the dollar, obviously we've been edging to the downside. Monthly still screams a little bit of vulnerability near to at the moment, but I think in my opinion, I believe we're in the final phases of this dollar downside, but again, we'll see. You know, I don't have a crystal ball, but I think we're in those final phases, and I'm going to get onto another point in a moment. But when you look here at the daily, obviously, structurally, it's been clean to the downside, right? We've been printing lower highs, lower lows, lower highs, lower lows. You get the point. You know, breaking out nice flags, nice pennants, and then obviously this latest wedge subject to another potential drop to the downside. Maybe we breach 100 before that big buying comes into play, because it's a big area as well. You got to remember, this is the lows here. Okay, are those the lows of 2023? Yes, these are the lows of 2023. So a significant area where we could come down and find, you know, regather some bullish momentum. Maybe we take one more drop ahead of some buying. And the reason why I think we're in the final stage of the dollar downside as well is, we'll save this for another video, but we are seeing signs of a potential global slowdown, right? And, you know, you have to remember the dollar's a safe haven. I mentioned this previously. The dollar's a safe haven. It is attached to the largest economy in the world. It is the reserve currency of the world. So if we do have this economic downturn, remember we've had a period of an economic boom, and now we're getting close to this new cycle of an economic bust. In my opinion, we are getting data slowing down. We are getting central banks starting to cut rates. So if we really get a pickup in this narrative of, economic slowdown, global recession fears, where do you think money's going to go? It's going to flow back into the dollar. So at some point, we are, as I believe, we are in this final phase of this dollar downside, and at some point this momentum is going to pick up. Whether it happens at this zone here where we're at now, okay, around this mid 100 mark, 100.50, or do we come and challenge and pair back or come back to this big demand zone, the lows of 2023, and that momentum picks up to the upside? Either way, this is a massive week for the dollar. Have your fingers on the pulse, because it's going to be huge. Also expect plenty of volatility around the pound, because we do have a rate decision from the UK, the Bank of England rate decision, but we also got UK CPI data. Now, look here at my screen. Obviously, volatility will kick off on Wednesday, where we've got UK CPI, and CPI expected to remain still somewhat sticky at 2.2%. I say sticky because it's still a little bit above the Bank of England's target, holding steady there. The Bank of England's target is down at 2%. So inflation is expected to remain above their target. One of the key things, if you look, is obviously on Thursday. Well, sorry, what I was going to say. One of the key things is inflation that makes up, the Bank of England's decision with interest rates, right? Of any central bank. Now, at their last decision, you see here they cut by 25 basis points. Remember that, okay? Rates were at 5.25%, and they cut by 25 basis points, bringing the interest rate down to 5%. Now, that was quite a hawkish cut, in the sense of they were cutting, but they were not committing to more. And the reason being was that because there's still risk to inflation. Why? The services inflation is still high in the UK, right? And we've seen a number of Bank of England members warning about that. And that's why, if you go back to our videos ahead of this decision, I said it's going to be a hawkish cut. That they're going to cut, but they're going to still give some caution around services inflation. I mentioned that. Go back to the video. I also mentioned about the fact that wages in the UK are still high. Remember, if wages are still high, what do you think people are doing? They're spending money. Spend. And if we're still spending, of course, we're going to keep stimulating prices of goods and services. These businesses are not going to go and put down their price, are they? If we're still spending, if we're getting paid more money. Do you understand? Economics 101, guys. So, with that being said, okay, if you look at the last wages from the UK as well, they still remain pretty healthy. We saw that, let's just bring it up here. UK average earnings. Look, so it came down to 4%, right? Slightly below expectation, but the key thing for me is that previous was even revised higher, up to 4.6 from 4.5. So, and then also claimant count change, the amount of unemployment benefits, real good number here actually. Only 23.7 thousand unemployment claims. The markets were expecting it to really worsen to 95.5 thousand, and the previous was revised higher from 135,000 to 102.3. So the labour market is relatively healthy for the UK, and I think that poses a risk to the Bank of England wanting to bring down inflation. So that being said, there's still going to be an element of caution there, and I think again this is going to be a hold from the Bank of England for a few months, with regard, or at least a month or two, which could provide some support for the pound, in my opinion. Now, if you look at obviously GP versus dollar, as I always say, I just look at the currencies versus the dollar as a base case, but you can look at GP versus CAD, you can look at GP versus Aussie, GP versus NZD, and find some divergence there. You might find some divergences by conducting some analysis on a fundamental macro level. Simple. Look, in the latest week, we've staged a rebound after a couple of weeks of decline, but you can see the overall trend has been to the upside. We've been aggressively buying dips there, pushing to the north. It's been really clean. I previously been enjoying this upside pressure for GU. GU tends to be my baby. Look, we formed a bit of a bullish flag, descending channel either way, looking for potentially breakout to the upside. We had a nice little morning star there, validated by that closure above there, that bullish candlestick, and now we're just sitting around that trend line. We're just sort of magnetized to that at the moment. Perhaps some dip buying could come into play here. Maybe we're forming a potential bullish flag. Just a potential, guys, Obviously it comes down to now keeping an eye on these macros to see if we can get the trigger to force this breakout to the upside, or is it going to disappoint and we fall back within this range? Now, obviously, as I say, keep an eye on that CPI. If that does remain sticky at 2.2% or even comes out higher than expected, that GU is going to push to the north, especially then if that coincides with a Bank of England that are just like, look, we're not cutting again for a while. We still see risk to inflation. Let's just sit on our hands for a month or two, a decision or two. We'll take it case by case, dependent on inflation. Then that should support the pound to the upside, as well as, you never know, we could get decent retail sales here as well due on Friday. So expect plenty of volatility around the pound as well this week. Also expect decent volatility with the Japanese yen, because another rate decision. We've got the Bank of Japan due to announce rates now. We're not expecting any change at this decision. We're expecting rates to hold steady after they had increased rates. Rates are sitting at 0.25%. Remember, for many years, Japan had low rates. They had negative rates because they wanted to bring up inflationary levels for those years where they've suffered with deflation. People are just not spending their money. So they had to try and get inflationary levels creeping up again. And now the fact that we've seen a little bit of economic stability, we've seen inflationary levels picking up where the Bank of Japan wanted them to. They started obviously raising rates, and we've had liftoff. Now, if you look at my chart, remember this big drop here with all the yen pairs. Can you see that across the board? And the reason for that was because the BOJ, starting to move into higher rate territory. Remember all of these months here, it's just a quick reminder, we had this massive push to the upside with all yen pairs, right? All of them were just moving in one direction, and the reason for it is because, simple, we had a massive massive monetary policy divergence. Other major central banks were raising rates, they had higher rates, but the BOJ had low rates. So remember, you've got to follow the flow of money, guys, right? Foreign investors are seeking higher yields. Which economy is going to pay me the highest rate of return on my investment? Okay, Japan have got zero in rates, zero yield I can earn on my money. I'm not going to put my money there. I'm going to go and put my money in the States where rates are about 4%. I'm going to go and put my money in the UK, Australia, New Zealand, Eurozone, Canada. You get the point, right? So that's where the monies are flowing. That's why all these pairs are moving to the upside. But, my friends, now we're seeing interesting stuff. That was known as a carry trade. People borrow in a low interest rate environment. They go and invest that money in a high yielding. So imagine someone in Japan, they don't have to pay. Interest is like nothing, right? On that money that they borrow. Then on that money they borrow for cheap, they go and invest it in high yielding economies and earn a yield on that. Smart, right? It's the carry trade. Now, where the BOJ is starting to have liftoff with rates, is discouraging those outflows from Japan, keeping money a bit more domestically, because rates are going to start, rates are creeping up. So then we'll get an unwinding of that carry trade, which is why we had this massive drop with all yen pairs. Now, in my opinion, I think we're going to continue to see that unfold, especially as this situation of the BOJ continue to raise rates where other central banks are now cutting, bear in mind. So we're just narrowing that divergence. And if anything, if we're talking about action right now, we have a divergence because the Bank of Japan are hiking, other central banks are cutting, and they're in that cutting path, whereas the BOJ are in a hiking path. So it's a divergence there, and flows will just keep picking up into JPY. And another thing that will support JPY and continue to see these pairs move to the south, obviously with specific trade ideas, you conduct that yourself. I'm just giving you the macro information here. But remember how I just noted with the dollar, we could have those safe haven flows into the dollar if we get that massive economic slowdown. Same thing for yen. Remember, yen JPY is a safe haven, guys. So we could see a double positive there for yen flows. Just to round off, guys, there's also data from Australia with their labour market data. And this is important to note because remember the RBA have been quite hawkish, noting of potential rate hikes. Other central banks talking about rate cuts, but they've mentioned the possibility of a hike if inflation still remains away from their target. And obviously, if the labour market's still solid, that poses risk to inflation coming down. Remember, decent employment, decent wages. That's going to bring up potentially inflationary levels. So we'll keep an eye on that to help us shape up our views or market expectations of rate action from the RBA. And then same thing for the Bank of Canada. We've got inflation. Inflation's been cooling, which is why the Bank of Canada have been cutting rates. So if that cools further, it'll only add to more market pricing of rate cut bets from the Bank of Canada, which will weigh on CAD versus certain peers. So you can use that analysis and see where am I getting a divergence? Is the Bank of Canada going to be cutting faster than the Eurozone? So maybe we see Euro CAD move higher. Or is the Bank of Canada going to be cutting faster than New Zealand or the UK or whoever, right? You conduct that analysis. So keep an eye on those data points as well. So volatility expected for Australia and CAD. So as you can see, guys, this is a very, very busy and exciting week. Without a shadow of doubt, though, obviously FOMC rate decision takes the spotlight. Other than that, have an amazing and blessed week, and I'll catch you on the next video.